And I'm Mira.
And wow, if you are managing a portfolio right now, today wasn't just a volatile market session. It was honestly a brutal collision.
Oh, absolutely brutal.
Right, between the unstoppable force of this physical AI infrastructure build-out and then the unyielding macroeconomic reality of inflation and war.
I mean, we're talking about a 10-gigawatt power demand for a single data center.
Yeah.
A secret military escort mission in the Strait of Hormuz, and, a historic shock to global liquidity from the Bank of Japan.
It's just a lot to digest. So for Wednesday, June 10th, 2026, the S&P 500 futures actually reached an intraday high of 7,404.75.
Right, before completely and violently reversing course.
Exactly. A severe sell-off dragged the entire index down to close at 7,264.75.
And volatility just exploded across the board. The VIX spiked to 22.22.
Which is huge.
Yeah.
And gold. You'd normally expect gold to catch a bid in a panic like this, but it suffered a massive collapse.
Yeah, plunging from an intraday peak of 4,281.7 all the way down to 4,092.70.
And sitting right in the center of all this chaos, WTI crude oil staged this powerful rally to close near its highs at $91.77.
It really was a defining session. So our mission for today's deep dive is to unpack exactly how these forces are interacting.
Right.
We're going to look under the hood of the incredibly sticky inflation data we just got, examine the severe geopolitical escalation in the Middle East it's physically choking off global oil supplies.
Yeah.
And explore how these massive macro pressures are colliding with an AI mega capex boom that is just completely distorting the broader market.
Yeah, completely distorting it. But before we jump into the timeline, just a quick but important reminder, this deep dive is strictly for market context and discussion.
Yep.
We're here to help you understand the baseline narrative and the fundamental logic behind today's market moves. This is not personal investment advice or, a recommendation to buy or sell any securities.
Definitely not. So with that established, we really need to look at the timeline chronologically, because the pressure on U.S. equities was building long before the sun even came up in New York.
Which brings us directly to our first session. So what set the stage before the U.S. session opened today?
Well, to understand the sheer gravity of today's U.S. Open, we have to look at a massive catalyst that actually hit the tape late Tuesday evening.
Right, the Japan news.
Exactly. At 8:18 p.m. Eastern Time on Tuesday, June 9th, reports confirm that the Bank of Japan is preparing a truly historic monetary pivot.
A huge pivot.
They are raising their benchmark interest rate to 1% and entirely ending their long-standing bond tapering program.
Which, if you were mostly focused on domestic U.S. equities, a 1% rate in Japan might sound like, a minor overseas headline.
That sounds tiny, yeah.
But mechanically, in the global financial plumbing, this is an earthquake.
It really is.
We frequently talk about discount rates as financial gravity, and this is the ultimate real-time example of that concept. For years, Japan's zero or negative interest rate policy effectively made them the fountain of cheap capital for the entire world.
Right. Institutional investors would borrow yen for practically nothing.
Exactly. Convert it and buy higher-yielding global risk assets, especially U.S. tech and treasuries.
So the structural shift here just cannot be overstated. When the BOJ suddenly raises rates to 1% and halts their bond buying, Japanese government bond yields spike.
Naturally.
And that mechanically triggers a massive repatriation of capital. Those Japanese institutions have to sell their foreign assets.
Dumping U.S. equities and treasuries.
Yes, to bring that capital back home to cover their newly expensive domestic liabilities. This rapidly unwinds massive global carry trades, literally draining physical liquidity out of risk assets.
And the market was already pricing in that contraction before the U.S. pre-market even gained volume.
Exactly.
And as that global liquidity tightened overnight, the focus shifted to North America right before the core U.S. equity action began. At 9:45 a.m. Eastern Time today, the Bank of Canada held its benchmark rate steady at 2.25%.
Yeah, and Governor Tiff Macklin's decision to hold rates steady perfectly highlights this agonizing dilemma facing neighboring central banks right now.
It's a really tough spot.
It is. If you look at the underlying Canadian economy, it is decidedly sluggish. The domestic data just screams for a rate cut to stimulate growth and ease mortgage burdens.
But his hands are completely tied by the currency market and commodities.
Right.
Let's break down the math on that paralysis for a second. Oil is priced globally in U.S. dollars. If the Bank of Canada cuts rates while the Federal Reserve holds firm, the Canadian dollar immediately depreciates against the greenback.
Oh, which is a huge problem.
A massive problem. because that means imported goods, and specifically energy, becomes significantly more expensive in local currency terms. They can't risk cutting rates to save domestic growth because they would just be importing a massive wave of energy inflation straight through their front door.
And that specific fear of imported energy inflation was heavily amplified by the tense global backdrop carrying over from the prior session.
Oh, yeah, the helicopter incident.
Right. Heading into Wednesday, markets were already highly agitated by Tuesday's crash of a U.S. Army Apache helicopter near the Strait of Hormuz.
Yeah, and even though it was an isolated incident and the crew was safely rescued, the aggressive rhetoric and the military posturing surrounding the crash, it just set a deeply fragile, risk-off tone for global equities.
It really did. So the table was set for a highly defensive posture. You had the threat of tightening global liquidity out of Japan.
A paralyzed central banks in North America.
And a geopolitical powder keg sitting right on top of the world's most critical oil choke point. Which
brings us right into our second session. What exactly moved markets during U.S. trading hours today?
Well, the primary catalyst dropped right out of the gate. At 8:30 a.m. Eastern Time, moments before the bell, the May CPI report was released.
The big one.
Yeah. The headline CPI number accelerated to 4.2% year over year. But if you dig into the internals, the really concerning data point was the crucial supercore CPI reading.
Yeah.
That accelerated to 3.67% year over year and 0.27% month over month.
And look, if you're managing a portfolio, supercore is the number that keeps you awake at night because it strips out housing and energy to focus on underlying service sector stickiness.
Things like insurance, medical care, specialized labor.
Exactly. Those costs are notoriously difficult to bring down once they accelerate. Now, I did see some analysts pointing out that immediately after the release, short-term interest rate futures actually showed traders briefly paring back their bets on aggressive Fed rate hikes.
Yeah, the theory was that since the number didn't completely blow out the worst-case estimates, maybe the Fed wouldn't hike further.
Right. But I have to challenge anyone trading off that momentary futures flutter.
Oh, absolutely. It was just a classic brief flutter. A momentary sigh of relief that the absolute tail risk scenario was avoided.
Exactly, because the actual equity tape told a completely different, unforgiving story.
Yeah.
As the session progressed, S&P 500 futures didn't rally on relief. They drifted steadily and painfully lower.
Yep.
The physical reality of the equity tape proved that stubborn service sector inflation is cementing a higher-for-longer rate environment. And sustained high rates compress valuation multiples relentlessly, regardless of what, short-term futures traders might be hoping for in the first 5 minutes after the print.
Absolutely. And, the tape was also digesting a massive real-time escalation in the Middle East that dominated the intraday headlines.
Yeah, the retaliation.
Right. Following Tuesday evening's U.S. CENTCOM strikes on Iranian air defenses, we saw a fierce retaliation. Iran launched waves of drones and ballistic missiles at U.S. military bases in Bahrain, Kuwait, and Jordan.
I mean, when you look at multiple bases coming under ballistic missile fire across 3 different sovereign nations, it feels like an unpredictable geopolitical disaster.
It does.
The immediate instinct is to price this as a regional war spiraling totally out of control, which drives a massive risk premium into the market.
It absolutely drives a risk premium. But we should also try to view this through the lens of geopolitical brinkmanship as negotiation leverage.
Interesting. How so?
Well, rather than pure chaos, extreme military posturing, especially highly telegraphed drone and missile strikes, often acts as a precursor to forcing diplomatic off-ramps. Both sides are basically demonstrating their kinetic capabilities to strengthen their positioning in the ongoing back-channel nuclear talks.
I mean, that game theoretic logic makes sense in a vacuum. But the physical oil market doesn't have the luxury of waiting for a diplomatic off-ramp,
That's very true.
And the supply constraints are biting right now. At 10:30 a.m. Eastern Time, the Energy Information Administration reported a staggering 7.228 million barrel drawdown in U.S. crude oil inventories.
That is a massive amount of physical supply vanishing from the domestic market.
It is. And the U.S. government's reaction to that drawdown tells you everything you need to know about their internal panic levels regarding crude prices.
Yeah, just 20 minutes later.
Right. At 10:50 a.m. ET, the U.S. announced an emergency strategic release of 40 million barrels from the petroleum reserves. And on top of that, they declassified and revealed a secret military escort mission actively protecting commercial shipping vessels in the Strait of Hormuz.
Yeah, when the government is simultaneously draining emergency reserves and deploying naval assets to babysit commercial tankers, you are watching the physical manifestation of energy shocks as a delayed consumer tax.
Precisely. A 40 million barrel SPR release is honestly a Band-Aid on a bullet wound when WTI crude is surging past $91 a barrel.
It doesn't move the needle enough.
Because that $91 crude directly translates to higher diesel costs for shipping, higher utility costs for manufacturing, and ultimately, higher prices at the checkout counter. Lower margin businesses are going to have their earnings absolutely crushed absorbing these input costs.
And just to add one more layer of friction to those businesses, we saw a sudden injection of trade uncertainty just before noon.
Oh, the USMCA news.
Yeah. At 11:56 a.m. Eastern Time, President Trump publicly challenged the renewal of the USMCA, the U.S.-Mexico-Canada Agreement. He explicitly demanded better trade terms from both nations.
And the market's reaction to that was instantaneous. When you challenge a major free trade agreement, you immediately inject new supply chain pricing variables into the market.
Exactly. Look at the Industrials ETF, XLI.
Yeah, which heavily relies on cross-border manufacturing, where parts literally cross the Mexican border multiple times before product is finished.
Right.
The threat of new tariffs forces markets to instantly price in margin compression for those companies, which helped drag XLI down to close at 169.66.
So the confluence of these events during the U.S. trading hours was overwhelming.
Yeah, a perfect storm.
You had sticky supercore inflation cementing higher interest rates, an exploding physical energy shock driving up input costs, and unexpected trade friction threatening supply chain margins. That is the fundamental logic behind today's aggressive, broad market sell-off.
It makes complete sense when you lay it out like that. But, as always, the broad index masks the activity beneath the surface. Which brings us to our third session. How did corporate events play out today, and what should we watch next?
Well, if you strip away the macroeconomic gloom, the underlying story in the corporate sector is that the AI mega capex supercycle is completely validated.
Totally.
And it's operating on a timeline that ignores inflation prints entirely. The $700 billion big tech capital expenditure cycle has officially moved from just procuring silicon and software to pouring concrete and securing heavy power infrastructure.
And the scale of this infrastructure build-out is becoming difficult to comprehend. We received news carrying over from late Tuesday into today's session that OpenAI is actively negotiating a 20-year lease for a massive 10-gigawatt data center in Ohio.
10 gigawatts?
Yeah, and crucially, NVIDIA is reportedly stepping in to provide the credit backing for this facility.
Which is wild. Let's put 10 gigawatts into perspective for you. The entire city of New York draws roughly 10 gigawatts of power on a peak summer day.
Oh.
OpenAI is attempting to lock down that exact amount of power for a single corporate facility. This perfectly illustrates the reality of power access as the ultimate AI bottleneck.
Yeah, the limiting factor for artificial intelligence is no longer just the algorithmic capability.
Right.
It's whether you can physically generate enough electricity to cool the server racks. And with NVIDIA providing the credit backing, you are seeing the silicon provider physically finance the power infrastructure just to ensure their chips actually have somewhere to plug in.
Exactly. Additionally, CDO Sam Altman signaled that OpenAI expects to go public within the next year, and they are preparing a near-term internal tender offer, valuing the shares at $687.69.
Incredible.
We often discuss mega capex as a market fragility mask, and this is exactly what we mean. When you have a single tech entity deploying infrastructure at the scale of small nations, it creates immense concentrated financial strength.
But that localized strength masks the severe margin pain happening to the rest of the S&P 500 constituents who are out there struggling with 4.2% inflation and 91 oil.
Exactly.
And, that incredible demand for concentrated growth isn't limited to AI infrastructure.
Yeah.
Overnight, at 1:25 a.m. Eastern Time, reports surfaced regarding the explosive global demand for the upcoming SpaceX IPO.
Oh, yeah, that was huge.
The private order book is reportedly over 4 times oversubscribed.
Mm-hmm.
It is generating such intense demand that it's physical moving currency markets.
Which is crazy for an IPO.
It is. It drove an estimated $1.5 billion in foreign exchange conversion buying in South Korea alone. as institutions dumped local currency to acquire the dollars necessary to buy into SpaceX.
However, while the private markets are throwing limitless capital at these tech frontiers, a massive regulatory clash is brewing in public.
Right.
At 11:53 a.m. Eastern Time today, President Trump met with AI industry leaders, setting a highly supportive tone by promising the technology would generate immense public wealth.
But that clashed violently with statements from Anthropic CEO Dario Amodei.
Right, who directly challenged the White House by calling for the government to have explicit legal authority to halt the deployment of new AI models.
Look, if you're holding these trillion-dollar tech valuations, Amodei's request should make you incredibly nervous. If the government actually institutionalizes the authority to halt new AI model deployments, that regulatory friction could severely delay the monetization timelines that these companies are heavily relying on to justify their massive capital expenditure.
Absolutely. It's a huge risk.
Well, folks, the closing bell is finally ringing. And I think we're all just relieved the market didn't ask Anthropic to halt our portfolios too.
Yeah, no kidding.
With the VIX spiking and oil prices surging faster than the demand for the SpaceX IPO, it was a rough day for anyone not heavily invested in aspirin. At least OpenAI is building a massive new 10-gigawatt data center in Ohio, which is great because we might need an AI supercomputer just to calculate today's broad market losses.
That's entirely fair.
So go ahead and pour yourself a strong drink, unless you're holding out for that strategic petroleum reserve release to lower the cost of your cocktail. Have a great night, rest up, and remember, tomorrow is always another chance to buy the dip.
Love it. But looking ahead to tomorrow, Thursday, June 11th, there are 3 critical macro events you need to watch.
Okay, what do we have?
First, we get the weekly U.S. initial jobless claims. Second, the May Producer Price Index, or PPI, drops at 8:30 a.m. Eastern Time, giving us another look at wholesale inflation. And finally, keep a very close eye on the U.S. Treasury 30-year bond auction scheduled for 1 p.m. ET, especially given the Bank of Japan's rate hike altering global Treasury demand.
That auction could be really messy.